Thank you, and a warm welcome to PAYTM's earnings call to discuss its financial results for the quarter and half year ended September 30th, 2021. From PAYTM's management team, we are today joined by Mr. Vijay Shekhar Sharma, founder and CEO, Mr. Madhur Deora, President and Group CFO, and Mr. Bhavesh Gupta, CEO Lending. Before we begin, a few announcements for all attendees. This earnings call is meant for existing shareholders of PAYTM, for potential investors and research analysts to discuss the company's financial results. This call is not for media personnel. If any media representatives are attending this call, request you to kindly drop off the call at this juncture. The information to be presented and discussed on this earnings call should not be recorded, reproduced, copied, or distributed in any manner whatsoever by any of the attendees. Statements or comments made on this earnings call may include forward-looking statements. Actual events or results may differ materially from those anticipated in such forward-looking statements. Finally, this earnings call is scheduled for 75 minutes. It will have a presentation by the management followed by Q&A. Kindly utilize the raise hand feature on your Zoom dashboard if you seek to ask a question. We will unmute your line and take questions in the respective sequence of raised hands within the scheduled time. However, please do ensure that at all times your name is visible as first name, last name, followed by organization name in brackets for us to be able to identify you before we take your question. A replay of this earnings call and a transcript will be made available on the company website subsequently. With this, I would like to request Mr. Vijay Shekhar Sharma to kindly initiate this earnings call.
Thank you, everyone. Good evening from India and good morning or good afternoon as you log in from different geographies. It is my pleasure to welcome you for PAYTM's first earning call after IPO. We have tremendous solid quarterly result out there, clearly showing platform scale, ability of ours to monetize payments, expand our platform in terms of financial services and commerce. It is my pleasure and privilege to welcome you all to in-detail discussion of our quarterly earnings. As you could see from our announcement, our revenues have increased year on year. Our revenues are increasing quarter on quarter. Impact of COVID, scale of system deployment, and scale in our non-UPI revenue, where merchant give us revenue charges, MDR charges for payments, and credit-led financial service, which gives us next level of monetization, is showing up. We believe we, in next few quarters, will be able to not just expand revenue, but increase more number of monetization methods and subsequently increase contribution margins in due course. Our team, myself, and everyone is super energized seeing the opportunity in front of us, and we are committed to execute and deliver great results forward quarters. I invite Madhur, my teammate, President and Group CFO, to give you detailed report card of this quarter. We look forward to take every question that you may have. If we are not able to answer in this call, we look forward to have an engagement with you on ir@paytm.com. Thank you so much and look forward to a incredible discussion today evening. Thank you.
Thank you, Vijay, and welcome everyone to PAYTM earnings call. This is for the quarter ending September 2021, and it's my pleasure to take you through the presentation, and then, as Vijay said, get into Q&A. So, just to remind everyone, for PAYTM, our mission is to bring 500 million Indians to the mainstream economy through technology-led financial services. And we believe we are making great progress on this journey. This is our Q2 FY22 numbers in a snapshot. Our revenue from operations grew to about 10.9 billion rupees, or about 1,090 crores, close to $145 million for the quarter. This was up 64% year-on-year. As Vijay mentioned, this was driven by 52% growth in non-UPI GMV, and this was the second consecutive quarter, as we are getting into showing quarterly numbers. We are showing consecutive quarters of 60% plus revenue growth on a year-on-year basis. So clearly great momentum. Our contribution profit hit a record high at 2.6 billion rupees, or 260 crores, about $35 million US dollars. This was up roughly 600% on a year-on-year basis. Obviously, this is a very large growth in contribution profit. Our margin in the same quarter last year was about 6%. In this quarter, we hit 24%. So there's a huge step change, and we'll talk a bit more about that later. Our EBITDA loss was 4.3 billion rupees. That's about 430 crores, or about $58 million. This was at a margin of negative 39% of revenues. In the same period last year, our EBITDA loss was 64% of revenue. So we have made a pretty significant improvement in this. In addition to contribution profit, this was driven by a reduction in indirect costs as a percent of revenue from 70% to 63%. So we continue to make organic improvement. I should point out that this reduction was possible along with increased investments in technology and increased investments in merchant base expansion. So this is an organic decrease. We have not slashed expenses. We continue to invest relatively fully in all the areas which we believe are creating great long-term opportunities for Paytm. Our GMV on the overall platform was about 2 trillion rupees, which is about 2 lakh crores for folks joining from India, or about $27 billion. This grew at 107% on a year-on-year basis, and this reflects obviously users and merchants growing on the platform and also increased engagement of both users and merchants. Digging into revenues, we saw, as I mentioned, continued momentum in revenue growth, up 64% year-on-year. This was driven by payment and financial services revenue growing by 69%, which further was driven by the 52% year-on-year growth in non-UPI GMV, as I mentioned earlier. We also had an increase in revenue from our financial services and others segment, or others business line, revenue line. This was a growth of over 3 times year-on-year in that revenue line. We also saw an acceleration of device deployment, which we'll talk about some more. We did share some operating metrics last Sunday, which I hope many of you have had a chance to see, but we'll talk a bit more about that. Our commerce and cloud business grew by 47% year-on-year. This was driven by 2 major factors. Our advertising revenues are showing very rapid growth. This is a business which is only about 1.5, 2 years old, and it's ramping up very nicely. And in our commerce business, just to remind everyone, a large chunk of this is entertainment and travel ticketing, which was heavily impacted during COVID, both wave 1 and wave 2, and it is seeing continued recovery post wave 2. Going back to GMV, our growth accelerated to 107% year-on-year in the September quarter. If you recall, in the June quarter, our GMV had also grown north of 100%. We also shared October metrics, which we have added here, where our GMV grew 131% year-on-year. And as I mentioned earlier, non-UPI GMV grew 52%. One interesting fact that we wanted to share with our investors is that obviously we have a set of merchants who do not pay us any MDR for payments. These merchants generated subscription revenue and merchant lending revenue, which in aggregate was more than 550 million rupees in Q2 of FY22. So that is roughly slightly more than $7 million. That is only 5% of our revenue from operations, which on the face of it may not look very high, but this tends to be very high margin revenue. So we are seeing value in all merchants and all GMV and being able to monetize them either directly through payments or through subscription revenues and merchant lending revenues. Our GMV growth is accelerating on a year-on-year basis in Q3 of FY22. And we have had very strong performance during the festive season. Part of that is here in the October numbers, and part of that will be disclosed to the market as we go further into the quarter. Our monthly transacting users grew 33% year-on-year in the quarter ending September 2021. In the October month also, we saw strong growth, 35% year-on-year growth. This is an increase in MTU of over the last 12 months of 14.4 million. So we've had a very productive 12 months with respect to user growth. Our engagement on the platform is also growing very fast. It's 55% year-on-year growth in average GMV per MTU. And this has all been possible while not increasing our marketing costs dramatically. We have kept it flat as a percentage of revenue at roughly 9% year-on-year. We talked briefly about devices earlier. To just share more color, our device merchant base expanded by 1 million in the last 12 months. Now, as we stand today, 1.4 million merchants have devices from PAYTM. We have really created this business over the last 2.5 years. Prior to that, our key merchant offering on the offline side was basically QR code, which we obviously continue to deploy. But now we have a range of devices available as well. This is strategically important to us because our device merchants show much higher retention and much higher average spends. And that has been a trend which we have noticed over the last 12 to 18 months, and that continues. In addition, 4% of our device merchants have already taken a loan through our platform. So our merchant lending business helps our partner banks and NBFCs to give loans to merchants, both merchants who have devices and the merchants who don't have devices. The merchants who do have devices, 4% of them have already taken the loan, and obviously this number is growing. You may have noticed some recently announced bank partnerships for POS. There's an announcement with HDFC Bank, and there are also partnerships with other banks. This is giving us very strong momentum in the LFR market, the large format retail market, in the offline world. So there's a huge push into the enterprise segment, which is being enabled partly through the bank partnerships that we have recently announced. Coming to our lending business, our value of loans disbursed through our platform reached $1 billion annualized in October 2021. There's a business which has really gone from zero to this $1 billion run rate in less than 2 years. There's been a 700% plus growth in number of loans disbursed in Q2 FY22, and there's been a nearly 500% growth in the value of loans disbursed. And as I mentioned earlier, this is all translating into the line called financial services and other revenue, growing by about 3 times on a year-on-year basis. Just to remind everyone of a few highlights of this, all of our lending products, PAYTM Postpaid, which is our BNPL product, our personal loans product, and our merchant lending product, have fully digital journeys end to end. And we only do this in partnership, with tier 1 partners, which is usually large banks and large NBFCs in the country. Talk a little bit about contribution profit that I mentioned earlier. Our contribution profit hit 2.6 billion rupees, or 24% of revenue. I should point out that in the first half of this year, we have generated contribution profit of about 5 billion rupees, which is roughly $65 million. And this has exceeded the full fiscal 21 contribution profit, which was 3.6 billion rupees. So clearly there's been a huge step change in this. This is partly due to the fact that high margin monetization is kicking in at scale. For example, in our lending business, for example, in our advertising business, all of this helps change the contribution profile of the company. In addition, our PG costs have reduced from 0.52% of GMV to 0.34% of GMV on a year-on-year basis. So clearly, PG cost is a large cost for us, and the more we optimize it, the more contribution profit we generate and the more investment dollars we have. In addition, our indirect expenses has reduced as a percentage of revenue from 70% to 63%. along with investments in people, marketing, and technology. So as I mentioned earlier, our marketing costs maintained at 9% of revenue, despite even as we have increased our MTU very significantly. Our employee expenses have gone from 40% to 34% of revenue, even as we invest more in technology and more in merchant growth and more in merchant devices growth. Couple of breakdowns for segments. Our payments and financial services revenue, like I mentioned earlier, grew 69%. We broadly break this up into payment services to consumers, which is up 54% year-on-year. This is primarily driven by increase in non-UPI payment usage on our consumer platform. Our payment services to merchants grew 64% year-on-year, which really reflects growth in non-UPI GMV on the merchant side, on payment gateway and on our devices merchants. This has now hit a run rate of 16 billion INR or 1,600 crores, which is greater than $200 million revenue run rate. So just this business alone, our payment services to merchants, is a $200 million run rate business and very significant, very sizable. It is both for online merchants as well as offline merchants. And our financial services and others is up 250% year-on-year. This has grown from about 4% of our total revenues last year to 8% of our total revenues. And the major driver for this is growth in our lending business and our wealth business. Commerce and cloud grew 47%. The dark blue bars here are our cloud business, where we are seeing rapid growth in advertising revenue. And the light blue bars are our commerce business, where we're seeing continued recovery in ticketing revenue post wave 2. And just before we turn to Q&A, just a quick summary of our key trends. The trends in our businesses, on payment side, we are seeing growth of revenues and profitability due to growth of payments volumes from non-UPI instruments, including PAYTM payment instruments, and the growth in payment services to merchants. We are seeing recovery of high margin commerce business and growth of cloud business. And we're also seeing an increase of financial services driven by huge ramp up in lending. So that's the summary of the trends in our businesses. And how does that translate into operating and financial performance? We have been able to efficiently increase users, merchants, and GMV on our platform. We are seeing strong growth in momentum and revenue growth, and we think this will continue. We are seeing a step jump in contribution margin with clear trends towards continued year-on-year improvements. We are seeing indirect expenses as a percentage of revenue going down, and we are very well funded for growth opportunities ahead. Thank you very much, and I will turn this back to the moderator.
Mr. Deora. We will now proceed to Q&A. A kind reminder to all attendees to utilize the raise hand feature on your Zoom dashboard if you seek to ask a question. We will unmute your line and take questions in the respective sequence of raised hands. Kindly announce your respective organization name before we take a question, and do ensure that at all times your name is visible as first name, last name, and your organization name. The first question would be from Mr. Robert Short. Mr. Short, the line is open now.
Hi, thanks guys. It's Rob Short here from Tosca Fund. I just wanted to ask a little about the indirect expenses. Appreciate it is starting to come down as a proportion of revenue, but I wonder, if you kind of think further out into the years ahead. I mean, what sort of growth rate do you need to be seeing, obviously, to support the investment and growth in the business? I just wonder on a kind of more absolute basis how quick that needs to grow. Thank you.
Thank you, Robert. To be honest, over the next 1 or 2 quarters, we'll probably do more work on figuring out exactly what investment areas we sort of want to factor into our plan and share certain guidance with the street. I think the main focus areas right now is to build more technology, particularly for our merchants, and also the sales team, which is going and deploying devices, and which in turn translates into massive merchant lending opportunity. So at the present time, I don't have sort of a lot of guidance to share, other than it should continue to come down as a percentage of revenue, at least on a year-on-year basis. But over the next 1 or 2 quarters, we'll do more work to see if there's something that we can more formally share with the street.
Perfect. Thanks.
Thank you. The next question would be from Mr. Robert Marshall Lee. Mr. Lee, your line is open now.
Could you just talk a little about how you see the competitive environment, and just dovetailing with that, your marketing expense, which you highlighted at 9% of revenues. How do you assess the success or failure of that? Are there particular metrics you're using? And are there also other parts of the business where you see greater operational leverage on the costs?
Yeah. Robert, maybe I'll start and maybe Vijay can jump in as well. On the payment side, what I would say is that we have been very efficient and remained very efficient over the last 6 to 8 months. And we've been very efficient over the last 2 years in particular on being able to grow our users and be able to grow the quality of those users and grow GMV on our platform, while being efficient in marketing costs, both for user acquisition and retention and so on. And part of the tailwind in our business is that consumer cohorts are behaving very, very well and improving just as we move forward, right? And part of that is product. A large part of that is product. Part of that is large number of use cases, and part of that is just very doing a better job on getting the right source of users in. So we have been able to be very efficient on that. The second thing I would say is that on non-UPI GMV, we are seeing, in some ways, very strong momentum vis-a-vis competition, right? So whether it is on the issuing side where, with Paytm payment instruments such as Wallet, which is going through, very strong growth, or whether we see BNPL, which we can talk some more about. So on the issuing side, as well as on the acquiring side, right? Both in the offline world and the online world. So there are large merchants in the online world with whom we have made significant jumps in terms of the amount of activity that we do with them as a percentage of their business, so our penetration and our market share with them. And in the offline world, as I mentioned, the number of devices that we have, you can obviously see the data, and also the comment that we made about making a big push into the enterprise side of the business, including with bank partnerships. So we are seeing the significant momentum in growing non-UPI GMV, we're seeing significant momentum across the board. We are seeing significant sort of outperformance of competition, particularly in non-UPI GMV and in payment services to merchants. So we are seeing that a lot of that market starting to shift towards us. Which I don't know if you want to make any additional comments.
Yeah, thank you, Madhur. So Robert, what we've learned is that once you have a number of use cases led by Paytm, for example, like FASTag, which is a car tag for toll payments in India. Paytm is a market leader, and the customer has to sign up for Paytm Wallet, where we even earn interchange because we are on the issuer side of the business, along with obviously acquiring side business exists there. So we are able to make money from more number of Paytm payment instruments that customers are adapting, which we call non-UPI. The money that is generated in this is something which is helping us drive the marketing optimally, along with the marketing expenditures various banks are doing on Paytm. So imagine large private sector bank, public sector banks are who sort of have their credit card, debit card usage going down because, let's say, some or other reason that app-based payment is working out for customers, so they are not using cards. So these banks are using Paytm wallet as a channel to drive card usage, where they give free cashback, freebies, promotions, and they're funding it. So our marketing expenditure does not expand while our platform expansion happens. Similarly, there is also a very clear, I would say, network effect that we are seeing. The keyword of product ability, for example, like Google, PhonePe, who are sort of our consumer side competition, their products are based on third-party banks and systems. Our ability to run vertically integrated technology stack has started to attract the customer once they have experienced every other product. And we're talking in a growth of customer base, merchant base, with nearly flat marketing expenditure in a market where competition has actually enhanced this expenditure. So I call it platform product leverage. And overall, as a business, obviously, as you could see, the other revenue line items are also, which is a platform monetization leverage, if you will. So we continue to see this, Robert, that Paytm is becoming partner of banks to grow their payment usage and revenues. And we are also seeing, obviously, the monetization opportunities which are expanding on our platform very clearly seen in the marketing. Finally, one more thing, Robert, here. We have seen that customers are migrating from, let's say, UPI to wallet to postpaid. These are typically the non-UPI payment instrument that we talk about. And there, in these cases, we don't have to spend additional incremental money because the customer is already on the platform. So a payment customer of UPI is converting to a payment customer of wallet, and because he gets cashbacks on the wallet, because merchants are paying MDR for the wallet. Similarly, the person converts to credit instrument, buy now, pay later instrument postpaid, because customer is getting credit. We are now starting to make money. So sequentially speaking, the product stack is driving the customer towards Paytm, and then product, because the customer is on Paytm app, the CLM, customer lifecycle management journey, is driving him towards more MDR, interchange earning, revenue products that we have. So it's sort of network effect and CLM, customer lifecycle management, where we are seeing that we are not necessarily requiring to spend marketing expenditure, and we are seeing the growth out there.
Thank you so much. That's very helpful.
Thank you.
Thank you. For the ones sending some questions on chat, kindly utilize the raise hand feature on your Zoom dashboard. The next question is from Mr. Ankur Rudra at JP Morgan. Ankur, your line is unmuted now.
Hi, thank you. Thanks, Vijay and Madhur. Just if you could, as a first question, if you could elaborate on the advertising monetization in the quarter. You highlighted it's done very well. How are you finding merchants using this feature? Are there any different ways that you're finding them using the different using advertising on your app? And how do you see this evolving over time? What's the best way of thinking about this in the medium to long term?
Would you like to start with that question?
Yeah. The simplest thing, Ankur, we are pleasantly surprised that we have deep relationship of payments that expands that, because we have a consumer side business. So when you go to, let's say, large retailer, or when you go to a large online commerce company, these companies leverage Paytm app to drive traffic towards their business. And this win-win sort of combination, because we are able to help them get customer, is giving us advertising revenue, and it is also expanding our payment business surprisingly much better and faster, and sort of a network effect, if you will, from point players who are purely, let's say, POS provider or payment gateway providers here. So, Ankur, it's a combination of our consumer offering plus payment offering that gives payment merchants an opportunity. Second, we are able to also offer, as you can guess, a customer on Paytm platform would have financially checkboxed KYC verified customer, unlike on open internet or on a social network you sort of are guessing who's this customer. On our platform, it's sort of a KYC verified customer, which is an order of magnitude more valuable. And considering that we have more knowledge about this customer on our platform from financial status of the customer's context, there is a lot of interest that we are seeing continuously increasing quarter on quarter or month on month when we are able to reach out to marketeers or advertisers. Now we have internally cross-sell team of payment merchant sign-up team to cross-sell advertising. We also have started to build a separate independent advertising sales team, and even though very small, but they have shown really good, strong results for us. We fundamentally believe that for the traffic and scale and quality of customer base that we acquire on Paytm app, advertising will be a very strong bottom line contribution margin business. And Ankur, I want to expand to next level here. Think about for a brand in India or a retailer, including BFSI shops, if you will, meaning, let's say insurance company or anyone, you can think what are the key avenues that they can go to do advertisements. The classic ad networks of social networks, content platforms, and ad networks. And now we are going next level where a payment platform which has built its abilities, networked with more data and filters of customer, it is actually coming out as we believe that we are going to expand much more on this, and it could come out as a legitimately sizable option for the partners. When I say legitimate sizable, it means that we could potentially in future build a large enough choice for our advertising partners that they spend percentage which is meaningful enough on our platform.
Ankur, maybe I'll just add that I think when we started on this journey, and it really was number of our partners coming to us and saying, at the present point of, we know that Paytm works for me for transaction standpoint, but there are times when I don't necessarily want to convert to a transaction, but I know that Paytm has a user base to that I want to over time convert and is relevant for me. And we had a whole bunch of tools built, obviously internally, in terms of understanding users and being able to show them relevant use cases. So it was quite seamless, but a pleasant surprise nonetheless about how seamlessly that moved towards being able to open to third party, effectively to advertisers, that they could come and what we do try to do, however, is to show users things which are very relevant and which feel very native on our platform. This is so we don't sort of create additional properties, because at the end of the day, we are a transaction app and users come to us for that purpose. So we show them things, we try to show them things which are very relevant to them. So for example, if you go to our travel section, you may see airlines or tourism boards who are trying to speak to you. If you go to our entertainment section, you may see certain OTT apps in there which speak to you, in addition to obviously being able to find movie show times and so on. So we try to keep that very native on our platform, but just given the span of use cases that Paytm has, it can be very relevant and highly contextual traffic for our advertisers.
I'll add one last thing to this, Ankur. Our mini app platform, which is a sort of customer meaning merchant partner, is able to build a mini app experience within the Paytm app, is also one big driver of advertising revenue, because it is because they are able to complete the funnel on Paytm app itself, and we promote them that you should try incentivizing customers or advertise on Paytm app different places. So there is a better funnel conversion than a click that generates an app download outside. So mini app is behind the scene another engine that supports advertising. Thank you.
Thank you. This is very helpful.
Thank you, Uncle. Attendees who seek to ask any questions, we could utilize the raise hand feature on your Zoom dashboard, and we will unmute your line. Next question is from Mr. Rahul Jain. Rahul, your line should be unmuted now.
Yeah.
Rahul? Yeah.
Yeah. Okay. Yeah, hi. Thanks for the opportunity. I just wanted to understand the commercials for lending business. We have seen a significant jump in the way we've been doing the new loans. In terms of the commission that we earn on distributing such loan, do we receive the revenue upfront, and is it also accounted in that quarter itself, or how it is done in case you?
Yeah, thank you, Rahul. So our revenues are accounted upfront for the revenues that we receive. So our revenues are broken into broadly 3 buckets. There is a distribution marketing revenue that we earn from our lending partners for helping them reach out to consumers and merchants through our platform. Then there is a customer service fee that we charge them during the loan tenure of that particular loan. And our loan tenures are not very long, as you can imagine. BNPL is about 30 to 90 days, and the rest of the stuff is about 12 months to 13 months itself. And then there is, in cases where the lending partners use our collections infrastructure, we also have a collection-led, what I can say is the portfolio revenue that we get at the end of the tenure. So that's how the entire revenue is generated. So we only account for revenue on cash basis and not on accrual basis.
Okay. And any color you may want to give in terms of the split of the book in terms of personal loan to the NPL kind of thing?
Yeah. So at a very broad level, we haven't declared specifics, but I can give you a broad indication. At a very broad level, in terms of number of loans, as you can imagine, BNPL is a disproportionate share of our number of loans, followed by merchant and personal loans. In terms of value, we find that BNPL constitute maybe a shade over 50%. The rest of them are split equally between merchant and personal loans.
Okay. And when I see amount per loan kind of a matrix, it looks like sub 4,000, 4,000 to 5,000 kind of a number. And you say that 50% odd would be around for the BNPL. So is it fair to understand that even on the personal loan or the merchant loan, the ticket size that we may be operating would be in the 10 to 15,000 kind of a bracket?
No, actually not. That's not the case, Rahul. The fact that we have number of loans that we issue on BNPL, as I said, is a very, very large number. So it kind of pulls down the averages because BNPL we're operating at sub 4,000 levels, closer to 3,000, and that's by design. Whereas in personal and merchant loans, the ticket sizes are much higher, closer to 100,000 rupees.
Right. Understood. Thanks for that clarification, and join back with you.
Thank you, Rahul.
Thank you.
Thanks, Rahul. Next question is from Sophia Whitbread. Sophia, your line is unmuted now.
Hello. Could you tell us, with your customers or your new users, are you able to say which apps you think that they are coming from? Are they completely new to digitalization, or do you see that they're coming to PAYTM from perhaps a less comprehensive service provider?
Okay, we continue to see both kind of customers. Surprisingly, we are seeing the churn from other apps customers coming on our platform, and it is purely because the technology limitations other apps structurally have. They are working on the back of a typical traditional bank whose technology hasn't yet got scaled, or integration hasn't got scaled, or some other problem of method or integration or something. I can say we are seeing both kind of customers. It's sort of in geographical difference, where in southern India we are churning more customers from others, and in northern India we are getting new incremental customers, which are totally afresh. Interesting thing number 2, one of the reasons that we did our own survey, that why did they come? They do come for this, but then they retain themselves because there are PAYTM payment instruments which give them incentives, which are driven by the wallet and postpaid and PAYTM bank account. So all these 3 things are the hook that retains them and keeps them on our platform. By the way, our retainance has been much higher in these quarters. I'm smiling at it because when we saw the churn coming to us, we were in last 6 months were concerned about that. Does it mean that these are temporary and they can go back? Surprisingly, in our own feedback surveys from them, there was a lot more retention thanks to the lock-in that they create once the customer has created a KYC. It takes a lot to do the customer and KYC, etc. But once they've done KYC, stored some prepaid deposit with us, or opened a bank account, or locked in with, let's say, FASTag, which is a toll tag, these customers retain on our platform. Hope I
Thank you. That's very helpful.
Thank you. I think to Rahul, I wanted to add one extra thing, considering that we had Sophia, so I didn't expand on that. To Rahul, I wanted to add one more thing, that I personally believe issuing and collecting a smaller ticket size of loan is the magic movement, because it is not just costly and complex, it is also where the monetization, meaning I would say profitable monetization, is challenged even for the best of the financial institutions. I mean, talk about NBFCs, it is tough for them to distribute a loan of 5,000 and collect it at a cost which is profitable for them. Talk about banks, it is even tougher for them to go below 50,000, I'd say, or 20,000, I'd say. So I believe, Rahul, what we're doing is we're taking the tough thing first. It's surprisingly tougher for anyone to not even touch it. We are able to not just make money, we are able to rotate and have upsell, etc. also being done here. So we are actually liking that we are expanding smaller loan ticket size over larger loan ticket size, because the magic happens when you are able to build a business model of large number of users with smaller loans than a large loans of smaller number of users. And we fundamentally believe that we will continue to drive more number of users to the credit story with these small loans, who in turn then over the period obviously start to take larger ticket loans from our partners. Thank you.
Thank you. The next question is from Mr. Charlie Linden. Mr. Linden, your line is unmuted now.
Hi, thank you for the time. I just wanted to ask on the collection experience so far. Obviously, the number of loans has increased dramatically that you've originated. What's the experience been like versus your own expectations, and I guess versus your banking partners?
Charlie, the experience has been very good so far, and I'll give you, while we do not have access to the portfolio performance directly, because the lending partners take the risk on their balance sheet and not necessarily that every information is shared with us. So we have 3 ways of looking at this data to give you some sense of how trends are looking. First is that where we're doing collections of the portfolio, which we do for a very large majority of the business origin through our platform, we can clearly see that the efficiencies and collections, both on merchant consumer loans, have been performing better than what lenders have given us targets. And we hence are also being able to make some bit of trail revenue and portfolio performance, which we are actually happy about. The second piece here is that we've been able to demonstrate even through COVID that newer partners have looked at our platform positively, which basically means very, very large banks and very large NBFCs we've added into our platform as lending partners in the last 6 to 9 months, which was actually the deep end of the COVID period that we were seeing. So they felt comfortable seeing what we were doing with other partners, and hence they obviously approached us and we approached them to kind of work together to add them to our portfolio. And the third is, in the credit business, it's very clear that if the lending partners are not happy with the credit portfolio, you would not see the growth that we've seen. So we are fairly confident that what they are seeing in that portfolio and what we can imagine that from our collection experience, that portfolio is holding up much better than they thought it would. And this has been the deep end of COVID as far as we are concerned. So all in all is looking fairly good. And we feel very confident that we can continue to have a very long runway ahead for ourselves on this business.
Okay, thank you. I just wondered, given that there's been some more news on regulation recently around this area, whether that had also been in line with your expectations, or whether there's any kind of changes to your plans needed as a result of them.
So Charlie, glad that you asked this question. I think we actually welcome these regulations or proposed regulations, if I may say, while these are a working group paper which has come out, and there is time for the industry to respond to it by end of December, and hopefully after which the regulator will look into the recommendations and working group recommendations together before they kind of formalize any kind of incremental regulations. But on the face of it, we see it in three parts. Number one, we were always adhering to the existing digital lending guidelines, which came in June of 2020. Right. So these guidelines that came in June of 2020, and when we look at those guidelines and read along with this working group paper, we see that there is a significant overlap of similar guidelines and maybe a lot more clarity, because maybe the working group felt that some of the players were not adhering to it in fully letter and spirit. But from our perspective, we've always demonstrated that we strictly adhere to the outsourcing guidelines and digital lending guidelines which exist today. The second piece to see is that there has been some level of gray in things like could you fund in a prepaid instrument, or could you go ahead and disburse credit on your own balance sheet without having a license, or could you give any kind of credit guarantees, etc. I think the working group has clearly called out that these are things which they don't think are appropriate. We have not been following that model. Our model is very clearly distribution technology and collection performance led, which is fundamentally being called out as a good model in the working group paper also. And the third thing is all about the size and scale that the working group expects the partners in digital lending space to have. In fact, they endorse that the credit dispensation in India is necessitated by the fact that technology is the only way forward to reach to the masses, especially in small businesses. And PAYTM, being a technology partner, has demonstrated that we are in the forefront of being able to achieve that objective, not only for our own customers, but in the overall ecosystem development. So I think we feel very happy and confident that if and when these regulations are implemented either in part or in full, it will further strengthen the platform capability that we've demonstrated and the model we've demonstrated. So yeah, there is nothing to be concerned from our perspective. Our model stays as it is, and our lenders are also absolutely aligned to that model.
Okay, great. Thank you very much.
Thank you, Charlie.
Thank you, Charlie. The next question is from Mr. Rahul Jain again. Rahul, I've unmuted your line.
Yeah, hi. Thanks for the opportunity again. And thanks, Vijay, for that additional input. So my next question is on the devices business. We have seen a significant jump from 0.3 million device to 1.3 million. I just want to understand a couple of things around it. How we are distributing this, what kind of KRAs do the distribution partner or employees do they carry in terms of the number of devices or any other variable that you might have assigned? What is that variable? And secondly, any split you want to share in terms of POS versus soundbox kind of a mix in the device?
Rahul, you're asking that what kind of inventory are the employees typically carrying with him for devices? Is that?
Incentives. So what are KRAs?
Our incentives are, incidentally, we have a business model led by performance and meritocracy. So incentives are not for selling, but getting a merchant who's longer term on our platform. So a person who's selling Soundbox does not necessarily need to sell Soundbox. He could get equally rewarded if this shopkeeper takes, let's say, a static QR, which is, let's say, photo QR, personalized QR, or Soundbox, and the merchant is active in long term. So there is sort of a bias selection by a salesman to discover what this merchant gets, because his incentives are not misaligned to oversell Soundbox. And the best part is that we have the highest retainance product ever. And I mean, obviously it is a context in our own company, but I can tell that we see highest retainance product like iPhone level of customer love on this product. I mean, it's phenomenal in terms of merchant behavior, need, love, affection, acknowledgement that we get on Soundbox from our customers. So what kind of incentives? Incentives are led by, like I said, not device or SKU only. They are led by that the merchant is staying longer term or fulfilling the service. Amount exactly, I don't think so that it is same for tier 1, tier 2, tier 3, or less penetrated, more penetrated market. So it's not that. But the best thing I can tell you, Rahul, is that our bonus on good customer service, meaning good merchant service and good sign up, is so much that FSC, field sale executive, could comfortably, and many of them earn 30, 40, 50,000 rupees a month. So
I just wanted to add that, one of the things that we learned is that obviously each product has its own nuances, but the experience of selling payment solutions to the long tail of merchants all over the country, that in itself has created a certain amount of IP in the country, right? in the company. And we started doing QR codes in early 2016. So this is sort of 5 or 6 years of experience that is sort of built in the company about to solve for the types of questions that you're asking, which is, how do you incentivize folks? Should it be different in different cities? Should it be different by different products? And how do you create that? Has grown from 10% last year to 25.5% this year. Right. So I would look at year-on-year trends as the primary way of evaluating efficiency on those lines, especially given the Q1Q is hard as a harder comparison.
I'll add to one more thing, Chandrasekhar, here, that your statement on break-even of payment, while we have not disclosed or are disclosing it like this, it is clear that some of the line items in our payment business are not just profit-making, but free cash flow generating. It is an important statement that I'm making here, that some of the line items in our payment business are not just profit generating, but free cash flow generating. So it should be clear that our payment business, and that is the big reason that we've called out non-UPI GMV in this quarter result, that our revenues and contribution margins are clearly growing on the back of payment and financial services business, where payment itself is the primary driver of it.
Thank you very much.
Thank you.
Thank you. Next, we'd like to call Mr. Anish Rai. Anish, your line is unmuted now.
Hi, good evening, everyone. So this is Anish from UBS. So a couple of questions. One question would be related to the MTUs we have. So I just wanted to understand. So if we see, say, some 60 million odd MTUs in a month, what would the breakup of vintage of these users? I mean, how many of these would be recently acquired? How many of these would be 3 years old on the platform or something, or some color of that sort? And the other question would be related to merchants. So I would, if possible, could you throw some color on the percent of GMV which comes from merchants which don't pay any MDR? I mean, there would be a lot of intersection between UPI and QR code based merchants who don't pay any MDR. So I would just like to understand how that works. And the other question for MTUs. Yeah, that's it. Thanks.
Thank you. I think what I'd say is that MTU math is obviously very complicated. Just to simplify it a little bit, what I would say is roughly in any period over 12 months, roughly 60 to 80% of our MTU are new and 20 to 40% are reactivated over a 12-month period, right? So I think those are the sorts of trends that we normally see. Of course, they are somewhat dependent on how well reactivation efforts are working and how well new user efforts are working over long-term trend, right? Actually, that data is a little bit more true for annual active users. On a monthly basis, of course, there are users who will come and they'll use us in a certain month and organically come back and use us in the next month, but even if they skip a month, they'll come back and use us in the month after. Right. So on an annual active basis, that trend has held up pretty well, which is 60 to 80% would be new and 20 to 40% would be reactivated. And I think on your second question, our merchant base is sort of north of 20 million as we have put in the prospectus and growing. We do, like I said, we have over 1 million merchants who have devices, right? So those are the merchants who generate us in the offline world. Those are the merchants who generate us revenue, including large format retail and so on. So I would start to look at the merchant funnel in that way. That the merchants there are merchants who pay us MDR because they want to accept all kinds of payments. Right. Those are online and offline. And there are merchants who are the sort of smaller merchants who may not pay us MDR, but they pay us for devices and merchant lending and so on.
Right. Yeah. So what Madhur has just said, Anish, it'll be nice to see our merchant base bucketized into no MDR merchants, or then second bucket would be MDR, which is PAYTM, non-UPI instrument-led merchants like Shoppers Stop or Big Bazaar or any other ones which take credit card, buy now, pay later, and PAYTM postpaid, wallet, etc., etc. Right. And third, and then in the two merchant, the second merchant that you're talking about are inevitably also paying for some of the subscription or platform fee also. So what we look at our merchant base is one merchant base which makes money using payment itself as a line item of revenue. Right. And second merchant base is a beautifully even more monetizable merchant base, because that merchant base, even though he takes 0% MDR payment on the platform, but he does not have access to the credit, and our credit partners, banks and NBFCs, are happy to extend credit thanks to the payment trail that we create. The advantage of payment trail is that they are not just able to disperse, but collect also from the collections every day that happen. So Anish, we earn on a 0 MDR merchant disbursement and collection margins on our platform. And that makes that merchant who's a 0 MDR merchant very useful for PAYTM platform, and equally and even more useful for our lending partner, because these become over the period priority sector lending and whatnot. So Anish, we continue to acquire merchants on both buckets. One who pay us for payment service, and that is why we are talking about non-UPI GMV there, and that talks about the merchants who give us money for payment acceptance and platform, basically device subscriptions and various other things. And second bucket, even more useful, because this is like you can guess tens of millions of merchants out there never have access to formal credit, and financial institutions and partners are looking forward to a solution in a platform like us. Remember, two-sided platform is an edge here. If we were purely a bank, we would have only seen the bank account of this customer, and then we would have wild guessed that what is this kind of money, no reason for, and no predictability. While it is a payment platform where we also have a mapping consumer detail on our platform, we can say, oh, Anish is paying this shop, means that the shop must be a high value shop. And oh, we have seen other customers who are of high value quality are paying this shop. So remember, our merchant business is fabulous from two aspects, payment revenue and credit revenue.
Got it, Vijay. Thanks.
Anish, I just wanted to clarify my earlier comment on MTU, just to make sure it came out right, which is we have this annual transacting user base,
Right.
Vast majority of them transact the next year as well, right? And then the growth comes from largely sort of new users who come to our platform, and in some cases, users who may have not used us in the previous year but used us in the year before, who come back due to some reactivation efforts that we do.
Right.
But the core base is the core base going into any new year is that vast majority of our existing customers do transact the next year as well.
Right. So Madhu, so probably just let me sort of put this question in another way. So just to follow up to what you just mentioned. So if my question is, so say if we have X annual transacting users this year, what percentage could I assume that these users would transacting even the next year? I mean, what would be the drop-off rates or something of that sort, if possible for you guys to sort of disclose?
We haven't quite shared that number, but it is the vast majority of those users.
Yeah, I think that's a good word Madhur is using.
Regardless of, yeah, sorry, go ahead.
Yeah, I was saying that Madhur is using the correct word. Anish, you can expect, if you remember a few minutes back, we were answering a question how a customer is spending more money, and that happens because the customer is actually living on this platform more number of times. So over the period, thanks to the number of use cases and the opportunities of multiple funding sources and services that we bring, that customer remains on a platform. Surprisingly, the commerce business that has been discussed in this call is one of the reasons that we started, that it is a key use case for customer to retain and come back on our platform.
Right. Sure. Thanks.
Thank you. The next question from Mr. Samir. Samir, your line is unmuted.
Yeah, hi. Thanks for the opportunity. Just looking at the number of sales employees, I see a sharp jump YOY. Probably that is also driving the merchant growth. What's the outlook here going ahead?
I think last year, the comparison of this number on September is slightly tricky for two reasons. One is, for one primary reason, because so the offline world just sort of came back a little bit later in Q2 last year, whereas this year obviously we had COVID impact in Q1, but by the time Q2 rolled around, there's plenty of opportunities for us to have feet on street and start, selling devices and so on, right? And we will continue to invest in merchant growth. You would have seen, Samir, from, when you sort of digest all of this data, you will see that we've been able to reduce our employee expenses as a % of revenue, despite increasing the sales force, right? So we have those levers in our business. We will continue to invest in merchant business, but we think we can do that while maintaining indirect expenses at a certain percentage of revenue and, in fact, decreasing it.
Yeah, it's an important thing to remember, Samir, that as Paytm vantage point, we see a tremendous opportunity to grow payments as a mode to acquire consumer and merchant. We continue to invest in use cases as engineering, professional, teammates. So as you could see the number of employees, there are more and more engineers added to the system because we are building for what new use cases and other financial services that we are building. Secondly, on the merchant side, like Madhur said, incredible, large, strong growth ahead is possible, clearly because more merchants are getting ready to accept digital payments.
I should just add, Samir, that just from accounting standard perspective, if we have insourced field employees, then they show up in employee costs. If they are outsourced employees, then they show up in other expenses as an outsourced cost. So depending on our specific strategy during those quarters, whether we are having those employees on roll versus outsourced, and there are some pros and cons of that, you may see some slight differences, right? So you may not be able to model number of employees straight into employee cost.
Sure. But this is the same number which shows in the RHP as around 6,500 as of June. Is that the same trajectory or is there a slight change here?
Yes, that's right. In RHP, obviously, we have more disclosure around
yes, absolutely,
function and so on. So if that's what you're referring to, that's correct. Yeah. And if you have further clarification, you can send us an email and we will just triangulate all the data and make sure you have good clarification.
Sure.
So,
Thank you and all the best.
Thank you, sir.
Thank you. We're just also getting close towards the end of the scheduled time, so we'll have time for 2 more questions. Next question from Mr. Nitin Agarwal. Nitin, you can unmute tonight. Hi, Nitin.
Nitin, if you're speaking, we're unable to hear you.
Am I audible now?
Yes.
Yeah. So thanks for doing the investor call, and thanks for taking my question. So I have 2 questions. Like, firstly, on the wallet load pattern, if you can comment as to how that has been keeping pace with the overall non-UPI GMV growth. And as we had imposed charges also on wallet load via credit card, so how has been the mix changed in terms of loading the wallet via credit card over past 1 year? So what has the mix come down to now?
The best part I can tell you, Nitin, is that our business of wallet year on year has been growing, and the credit card charges have either moved the customer to other payment sources like UPI, like debit card or net banking, or make that customer comfortable enough to pay those charges. So the clarity here is that we want to continue to expand on wallet as a use case, because this is here and running as a revenue line item for us, and it is year on year very decent growth. In fact, in many cases, we see that customers use wallet to add money, like we just now a few minutes back shared. The banks leverage wallet as a platform to give their debit card and credit card user expanded acquiring network of PAYTM. So this is strong growth, and we're very happy with how wallet growth is showing up.
I just wanted to clarify, when Vijay said it has moved users to other payment sources to add money to wallet, right? So users who, there are many users who have decided they want to continue using credit card and pay the charges which were implemented in calendar 20. And there are some users who have said they will move to another payment source such as debit card, net banking, UPI, and so on, and not pay the charges. And what that has done is that the wallet take rate has been the same, and it has become more efficient from a loading cost perspective. And some of that does reflect on the year-on-year contribution margin and year-on-year sort of percentage of payment cost as a percentage of GMV.
Thanks so much. And secondly, how do you really compare the productivity or the GMV contribution of merchants where you have installed merchant device like the Soundbox versus the one where you don't have it? And any approximation as to, because we have say around 24 million merchants, but in terms of Soundboxes, there is this huge room to expand. So how much can we really close the gap between the two?
I can tell you that the merchant who use Soundbox versus let's say earlier if they were using static QR or plastic QR or paper QR, the one thing that happens there is that the transactions consolidate, meaning no more multiple QR merchant, and it sort of becomes nearly exclusive. And clearly that could tell you that, and then merchant become even more comfortable because they are sure about the payment receiving. So we've seen the growths which are, I mean, strong is a word. I mean, Madhur, I leave you on.
Yeah, so I wanted to maybe just make 2 or 3 points on that. So one is, like I said in the presentation, device merchants, and large percentage of them, more than majority are Soundbox merchants. They do become significantly higher retention, and they also, the volume of transaction goes up very, very meaningfully. And which are sort of 2 separate points. I just want to be clear. And that is very efficient. It is dramatically better unit economics for us and dramatically better CAC to LTV for us, because you're not going out and sort of managing churn you're managing a very different churn profile than you would without devices. The second part to call out is this behavior that I mentioned, which is higher retention and more spends, which is higher loyalty on the platform, basically. That is nearly perfect behavior for them to become eligible for merchant lending. Because one of the things that you should be clear about is that we don't lend to merchants on thin file. And maybe Bhavesh can add if there's a follow-up on that. So it just accelerates the behavior of a merchant towards creating that effectively loyal behavior and thick file on PAYTM, so that they become eligible for loans from our partners. So this is, which is why I said it's strategically an important initiative for us. Nitin, I would refrain from giving forward-looking numbers on this. You have clearly seen the trends. We added 1 million in the last year, roughly 500,000 just in the last few months. So clearly this is off on a very strong trend and accelerating.
Oh, thank you so much.
Thank you, Nitin. And now for the last question of this session, Mr. Viral Shah. Viral, you have unmuted your line. You can ask your question.
Yeah, thank you for giving me the opportunity to ask the question. So actually, I had two questions. So the first one is, I know we have touched upon this earlier on Saurabh's question, but wanted to understand more so from a medium to longer term perspective. Does the working committee report that has been put out alter the medium to longer term different profit pools that Paytm could have developed? Say, for example, an underwriting or basically the underwriting decision needs to be made at the end of the banking partner, right? Probably, say, going down the line, given the kind of scale and the base that Paytm would have generated, this could have been one of the monetization channel for Paytm. And another thing linked to it is, does it kind of impact the BNPL business materially? Because primarily the economics in the BNPL business comes from MDR. And if you look at it, one of the recommendation is that this kind of credit needs to go into the bank account of the user. So on which the MDRs typically are not what it is on, say, a wallet.
Well, let me take both your questions. Purely from a model perspective, it's important to understand that the working group committee, as I mentioned earlier to Saurabh's question, we currently practice what largely is being recommended by the working group committee, because we've been following the current laid down guidelines of June 2020 digital lending guidance, etc. So purely from an implementation of working group, I think it will be very positive for our business model and will further amplify what we have believed in building the credit business at Paytm. And obviously it will remove some of the so-called smaller players who've been doing all kinds of things, I think, in the ecosystem, which may not be helping the digital ecosystem to prosper. Now, clearly from an economics perspective, there are two things to really remember in our model. Our lending business is aligned with our payments business. So as Madhur had mentioned, that we do thick files. Now, what we mean by thick files here is, we are not going and soliciting customers just for credit. So credit is a byproduct of what the customer or merchant does on our platform. More transactions they do, their ability to get credit through our lending partners increases. And more credit they consume, we believe the stickiness of the platform, be the consumer, the merchant increases. So it's kind of a flywheel, and that's a flywheel we are currently focused on. So it's just not the way to look at this business to make money from an element of a lending business, but in the total flywheel, we make money also on payments and also on credit and vice versa. Now,
Sorry, if I may just interject, apologies for that. But just my question was not more so from how the business is currently, but what it could potentially be. Say, for example, given the kind of data that you have over a period of time, you could have actually provided the underwriting tools or the data that you have. You could have provided a score like we have, say, for example, a Kakao Bank in Korea does, or many of these neobanks do, you create a score and based on which the lenders uses those scores to lend to customers. Does this kind of take away those kind of profit pools? Because now the lenders would be required to basically document the underwriting, the process that they have at their end. And secondly, actually, have you in terms of your interaction that you have with your partners, have you seen some indications of them having to now reevaluate, their plans or the arrangements that they typically have, not just with you, but generally?
Yeah. So Viral, to the second question, we don't know about the other partners, but from a Paytm perspective, we continue to have very, very strong support from our partners and growing. So there has been no letdown in terms of scale of business. If you are indicating based on the working group committee, the answer is no. To your previous question, I think our focus is always to build a legitimate business. Legitimate business means that we would like to protect what is the right product for the customers and their interests. And hence our belief has been that what Paytm offers is technology. What Paytm offers is a very, very unparalleled opportunity to distribute credit to a very large segment of customers. And also what Paytm offers is ability to collect using our digital tools, digital platforms, and the entire merchant ecosystem. So I think this is our strength. We would like to play to our strength. And I think there are enough and more revenue pools in our strength in medium to long term, which we would like to exploit.
Shall I add more, Viral, to what Bhavesh has just now said? It is important to know that our lending partners clearly see not just the technology and like you suggested, let's say we could build some score sorts and we could give them and that could help them. They see two important line items, which is the disbursement and collection as a even more critical KPIs than just the, let's say, help in underwriting, if you will. The reason I want to tell you, Viral, is that if they go on open internet, the cost of acquiring customer on open internet for NBFCs and banks is dramatically higher because there are many aggregator platforms and methods that open internet uses that the CAC remains way, way, way higher of the margin that they create. I mean, I would not hesitate to say that nearly all the margin they could have made would have gone in CAC if they would have chosen to scale on open internet. And the reason is, like I said, that there are a number of aggregators who sort of hijack the traffic, plus even the financial institutions don't have wherewithal of even they deploy third-party agencies to acquire customers of that grade. Companies inevitably seek multiple channels. And the advantage of Paytm is imagine a Diwali Mela. And I ask a financial institution partner, bank partner, NBFC to say, please open your stall here. And then the customers whom I have invited in the Diwali Mela are available to you. Paytm's approach is this, that come over, we have a customer base on the Paytm app who in workflow could have a conversion towards your product. This approach does not cost them increased cost of customer acquisition. If they go on loan disburse platforms like, many other Bazaar kind of products where there are just enlisted products, they also lose their own traffic to those platforms. Surprisingly, in our case, it does not happen because we don't fight with them to acquire their own customer. Instead, we offer potentially their customer or new customers on our platform that can be serving them. So very important to notice that Paytm's credit business is not zero sum to bank or NBFC's customer acquisition strategy on internet. It is actually adding to that as a key important channel. Number one. Number two, the ability, like you said, the data and the nuances of the system and abilities that we can help them with technology makes them percentage hit rate much better than if this customer was coming from open internet. And hit rate stands for that their credit policy would happily accept this customer with the nuances that they get to know once the customer is taking an application using our platform. In other words, they have a high quality lead issue. Now, once you've disbursed this loan, and you know that we are talking about small ticket loans, we are talking about large number of loans, it is even more important for financial institution and bank to collect this. That is where the Paytm plays even more important role. And you can imagine for a merchant, they probably will not have wherewithal to collect unless it is deeply integrated with a thick file that we are discussing, Soundbox, customer, merchant, that there is a large number of payment incoming. And from that, we are deducting daily, weekly, monthly, whatever the interest is. So, Viral, while it is nice to think of cacao-based business model where we could just throw very little and get advantage of that value, but it is far more fulfilling for our partner and us to deliver in these three buckets. Number one, disbursement, number 2, technology platform, and number 3, collection. And the best part, like Bhavesh said in beginning, RBI also has called out that please don't go NFLDG or loan guarantee way, because that is a credit agency's work. And we work complementarily. That is why the scale, that is why the margin growth and revenue growth. We are we're seeing very strong demand, Viral. I mean, number of queue of partners on joining Paytm platform for credit is so much that internally Bhavesh and me were working on adding more number of engineers only on adding integration partners, if you will. Hope you get the drift.
Right. To your other question, BNPL, I think small clarification. So there are 2 parts in the working group which at least has come out publicly. One part here is that they have observed that there are a lot of disbursements which other fintechs have been doing apparently as per their observation into prepaid instruments, namely either a wallet or a plastic card, which Paytm anyway doesn't do, which is what they made an observation that may not be the case, which should be further allowed and should the disbursement happen in a bank account. In case of Paytm Postpaid and especially BNPL, the lending partner disburses directly to the merchant, and hence that is a absolutely kosher use case, because this is typically the way EMI financing happens on the ground, wherein I go to purchase goods at a shop and the payment is being made by me for a loan that I've taken to buy that good from that shop. In this case, that goods could be digital, goods could be physical, and the disbursement is made directly to the merchant's account. So I think there is that clarification important, and hence the BNPL business that we run is absolutely in line with what is being recommended.
Right. And just as a follow-up, if I may, so how does the economics in this case work as to say the bank disburses money directly into the bank account of the merchant? So does bank then deduct 2% or 1.8% that is the typical MDR?
Yeah, so the economics, I don't want to dwell further. The broad level understanding here is that Paytm is also a payments platform. So the MDR is earned by Paytm, and then there is a component of interest and other fees which is shared between the 2 platforms.
Okay, thank you.
Thank you, Will.
Thank you, Viral.
Thank you. And with that, we come to an end for this first earnings call.